Hey everyone, it's Jason at Hard Money Bankers, and on this week's podcast, I want to go over exactly how rehab and construction funding works for real estate investors. It's a common question that I get all the time, and I know a lot of investors just can't figure out how to wrap their brains around it, and it's actually pretty simple in general, and I'm going to go through a few different variations so you understand how it works. So obviously there's different structures based on different types of lenders. You have a hard money lender, you have a private lender, or maybe you have a bank, and all of these may be structured a little bit differently. Obviously, if you're using a private lender, they might just say, here's the capital, just go build the house, renovate the house, do what you want. Or if you're using a hard money lender or a bank, it might be a little bit more structured where they do draw requests for you, and then as the work's getting completed, and the property's getting improved, they draw out money for you, okay? So most of these loans are based on either LTC or LTV. So either loan to cost, and that's LTC. And how loan to cost works is, for instance, let's say you're buying a property for $150,000 and needs $50,000 in renovations. Well, that means your cost is $200,000. And let's say the bank's willing to give you $70,000, right? That comes out to $140,000, okay? So that means the loan to cost is $140,000 in this particular case. That's loan to cost. Hard money lenders, typically like us at Hard Money Bankers, we base everything off of the loan to value based off of the after repaired value. So for instance, investors it helps investors if they buy them at a good price, because then they need less cash out of pocket for these deals. So for instance, we'll do 65% based off of 65% loan to value based off of the after repair value. So for instance, let's say we do a loan, let's say the after repair value is $200,000. That means we'll give you a loan of $130,000. Let's say you buy it for $100,000 and it needs $30,000 in renovations. Well, guess what? You just got 100% financing, 100% of the acquisition and 100% of the construction. Now, let's say you buy it for $120,000 and it needs $30,000 in renovations. Well, guess what? Now you need that $20,000 gap because your all in is $150,000 and we're still only able to lend $130,000. So let's go over a little bit how the draw process works and the construction works, because you want to think of everything as a whole. Think of it as your acquisition money and your acquisition costs and your construction costs, everything as a whole, and then you work backwards based off that. So typically banks and hard money lenders will reimburse you as work's getting completed. What do I mean by that? So let's say you have a $30,000 construction project, and this is obviously for a rehab. If it's a new construction and you're building from ground up, it can be $200,000 plus, obviously. But let's just say it's a $30,000 renovation project. So what happens is you go in, you start the work out of pocket with your contractor, either yourself or with your contractor, and as work is getting completed, you get reimbursed. So for instance, let's say it's a $30,000 rehab budget. You put on a new roof, it costs $7,000, and you do some demo work interior, and it costs three grand. So there's $10,000, right? $10,000 worth of work was completed. You get that done. And then the hard money lender or the bank reimburses you that $10,000 that you spent for it. Now, you could either spend it in cash by paying someone to do it, or with sweat equity by just doing it itself. But keep in mind, on these loans, they're typically based off of the completed value, the improved value, not the as-is value. And because of that, you need to make sure, and the lender needs to make sure that the work is getting completed, because as the work's getting completed, the value of the property is increasing. And as that happens, they're willing to draw more money. So let's say in this particular case, the loan was $130,000 with $30,000 in renovations. So you had $100,000 towards the acquisition price. So you buy the house for $100,000 and you have $30,000 in a rehab reserve that the bank or the hard money lending is holding. You do the roof and you do the demo and you have $10,000. Now the bank takes that $30,000, they draw 10 out of it, they wire you 10. So now their loan technically, although it was 130 gross, they gave you 100 up front to buy the property, and now they're giving you another 10. So now their exposure is $110,000. Then let's say you go put in some windows and whatever, you clean up some of the drywall and you do some flooring, you need another 10. Now they're in at 120. And at the end, when everything's completed, you get your last draw of 10,000 and you're all in at 130. And that's the gross loan amount. So hopefully that's clear of how that works. it's a pretty simple process, no matter if you're using a bank or a hard money lender. Obviously, if you're using a hard money lender, make sure they're local and they understand the project in general. Like us, we have a full-time inspector on staff, because I can't have someone come to us and ask for a draw and then it take a week. And I know, unfortunately, some banks are institutional-backed national lenders. That's hard for them to do because they might not have the resources to get through it quickly. We have a full-time employee on the ground that a draw comes in, we send it to him, he goes look at the property, and the next day, usually he's out there the next day, and then as soon as that's done that day, we wire the funds. So it's usually a 1 to 2 day turnaround time. It's a quick process. So in general, that's how it works. There's always a lot of questions of, do you front draws up front? And, obviously that's kind of a risky factor to a lender, because then you're giving them money before the work's completed, and then they're always behind the ball. They're always behind, they're behind schedule kind of on everything. I give you 10 grand up front, and then you go spend 10 grand, but what happens if, you didn't finish the work, then you're behind the game. So anything you do with construction and renovations, be careful, work closely with your contractors, make sure you know building codes and any other things. Make sure you always have a contingency plan in place. I'll tell you firsthand that the loans that default in general are for real estate investors that don't manage their construction projects right, and they run into construction projects. Either they under budgeted on the front end, or they didn't manage it along the way and they got themselves in trouble and it went over budget. Now, typically, if you have a 10% contingency plan in place, you can handle that. But if it goes any higher than that, you're in real trouble. So make sure you can execute. That's one of the other things that a lot of banks and hard money lenders will even look at, is to make sure you have the ability to do this. If this is your first project, you may not want to do a $100,000 renovation project. You may want to do a $30,000 lipstick on a pig project, something a little bit cleaner and easier, okay? Hopefully you found this helpful and you're able to now understand how funding works for real estate investors that are looking to rehab houses or build new construction or do any type of construction finance. It's an easy process. We do it all the time. Happy to help you with one. If you have one coming up, feel free to reach out to me directly at jason@hardmoneybankers.com. Take care. Thanks.